They told you support and resistance was simple. Draw a line where price bounced before. Wait for it to come back. Buy the bounce. Sell the rejection. That's it, they said. That's the secret. And you believed them. So you drew your lines. Neat, clean, confident. You watched price approach. You felt your pulse quicken. You entered. And then the market walked right through your level like it wasn't even there. Like your line was nothing but a ghost on the screen. Like the market didn't get the memo. And you sat there, confused. Stopped out. Again. Here's what nobody ever told you. Support and resistance are not lines. They are not zones. They are not even price levels. They are memory. They are emotion. They are the collective psychology of every trader who ever touched that price, and the story of who won, who lost, and who is still waiting for their revenge. When you finally understand that, everything changes. I spent years studying charts the wrong way. I was drawing lines like an architect, precise, methodical, proud of my structure. I had Fibonacci levels stacked on Fibonacci levels. I had weekly pivots and monthly pivots and supply zones and demand zones. My charts looked like a city grid, and I was losing money with the consistency of a professional. Something was deeply wrong, and I couldn't name it. It wasn't until I started studying how the old traders thought the operators from the early 20th century, the tape readers, the speculators who operated in an era before screens, before algorithms, before the illusion of certainty, that I began to understand what price really is. Price is not mathematics. Price is not a formula. Price is not a pattern that repeats mechanically. Price is the living record of human decision-making under pressure. Every single tick on that chart represents a moment when a human being, or a machine programmed by a human being, made a choice under conditions of uncertainty. Every level you draw on that chart is a graveyard of decisions. Some people made money there, most people didn't. And until you understand the psychology buried inside those levels, you will keep drawing lines in the sand and wondering why the ocean keeps washing them away. This is what I want to give you today. Not another textbook lesson about support and resistance. Not another YouTube explanation of horizontal levels and how to draw them. I want to give you the thing nobody explains, the living, breathing psychological architecture of price. The truth that the old Wall Street operators understood and protected like a secret. Stay with me. Most traders who fail do not fail because they're stupid. They fail because they are human in a game that punishes human instincts. Let me tell you what really happens when you draw a support level. You see price touch a zone 3 times. You see 3 clean bounces. Your brain does what human brains have been doing for 100,000 years. It finds patterns, it assigns meaning, it creates certainty from repetition. You tell yourself, this level is significant. You are right. The level is significant. But here is where the trap opens beneath your feet. You assume that because the level held before, it will hold again. You assume the market has a memory that works in your favor. What you don't ask, what almost nobody asks, is whose memory is being served at that level and what they intend to do with it. Think about what actually happens at a major support zone. Think about the ecosystem of human emotion living inside that price range. There are traders who bought at that level months ago and held. They are sitting on paper profits. As price approaches their buy zone again, they feel a familiar comfort. They might add to their position. Some of them will exit because they've seen this movie before and they're not sure it ends well. There are traders who bought at that level and got stopped out. They feel the wound. They feel the ghost of a loss. When price returns, some of them will buy again, not because the setup is clean, but because of something darker, something more primal. They need to be right. They need the market to validate what they once believed. This is not trading. This is psychology. This is need. There are the professionals, the institutions. They know exactly where the retail traders have placed their orders. They know where the stops are clustered. They know that below every beautiful support level is a dense forest of stop-loss orders, and those stops represent liquidity. And they are not afraid to push price through a level briefly, violently, to harvest those stops before letting price recover. This is why your lines get pierced. Not because technical analysis is broken, because you are thinking like a student, and the market is run by operators who think like predators. I remember a trade early in my career. I had a beautiful daily support level on a major index. Price had touched it 4 times over 6 months. I entered. I was certain. I placed my stop just below. Clean structure, I told myself. Textbook setup. Price immediately dropped through my level, took my stop, and within the same daily candle, reversed and closed above the level I had identified. I had been correct about the level. I had been correct about the direction. I was stopped out anyway, and I watched in silent fury as the market moved exactly where I said it would, but without me in it. I didn't lose that trade because my analysis was wrong. I lost it because I didn't understand what was living inside that level. I didn't understand that before the market respects a zone, it often has to shake out everyone who expected it to be respected. The professionals need your stop orders before they can send price higher. Your certainty, your confidence in the setup was the very thing that made you the liquidity. This is the first and most brutal truth about support and resistance. The levels that are most visible, most obvious, most universally agreed upon, those are precisely the levels most likely to be hunted before they hold. The market is not a machine. It is an adversarial organism, and it feeds on the predictable. There is another layer, even darker, even more important. Most traders approach a support level and think only about price. They think, will it hold or will it break? 2 outcomes. Binary thinking, and this binary thinking is a cage. Because the real question is not whether the level holds or breaks. The real question is how it approaches the level. The real question is what the volume is doing, what the spread of the bars is doing, what the character of the selling pressure looks like as price descends toward the zone. Is the selling confident and aggressive, or is it tired, breathless, running out of fuel? If you can read the condition of the market as it arrives at the level, not just the level itself, you begin to see the difference between a support zone that is about to hold and a support zone that is about to become a trapdoor. This requires you to stop being a line drawer and start being a reader. It requires you to stop asking the chart what will happen and start asking the chart what is happening. And that shift from prediction to perception is the single most difficult psychological transformation in trading, because the human mind craves certainty. The human mind wants to know the outcome before it commits, and the market will exploit that craving without mercy. This is the problem. This is the invisible wall between most traders and consistent profitability. Not a better indicator, not a more precise drawing tool, not a higher time frame analysis. The problem is that they are standing in front of a living, breathing psychological battlefield, and they are treating it like a geometry exercise. The day I stopped trying to predict the market and started trying to understand it was, the day trading became something I could survive. Let me tell you about the shift. Not the concept of the shift, the actual felt experience of it, because nobody ever talks about what the transformation actually feels like from the inside. When you've been trading long enough, you've had the losses, the real losses. Not just the financial losses, though those are real enough, but the psychological ones. The ones that leave marks. The trade where you doubled down when you should have exited. The trade where you held a loss so long it became a part of your identity. The trade where you broke your own rules so completely, so shamefully, that you couldn't look at your journal. And after enough of those moments, something either breaks in you permanently, or something transforms. I chose transformation. I'm still here. That is how I know it's possible. The first thing that had to die was certainty. I had to genuinely, deeply accept that I do not know what the market will do. Not as a philosophy, not as something I say to sound humble. As a lived reality that I carry into every single trade. When you truly internalize uncertainty, not as a threat, but as the nature of the game, your entire relationship with support and resistance changes. You stop asking, will this level hold? You start asking, given what I observe, what does the weight of evidence suggest is most likely, and what is my risk if I'm wrong? That is institutional thinking. That is the thinking of someone who has survived. The institutions do not trade levels, they trade imbalances. They are not sitting at a chart, drawing a line, and asking if price will bounce. They are watching the flow of orders. They are watching where supply is exhausted, where demand is being absorbed, where large participants are quietly accumulating before price moves, or quietly distributing before price falls. Wyckoff understood this over 100 years ago, and it is as true today as it was then. Before a major move up, there is accumulation, a period where large interests are building a position without revealing their hand. Price moves sideways, it tests lows, it shakes out the weak. It looks like distribution to the untrained eye, and then, when they are ready, when they have absorbed all the supply, the move begins. Your support level? It sits at the bottom of an accumulation range. The bounces you've been seeing? Those are the tests. The occasional breaks below your line that stop you out? Those are the spring, the deliberate undercut designed to trigger stops and create the final wave of selling that professionals absorb before launching price higher. When you see support through this lens, you no longer draw a line. You ask a deeper question. You ask, who is buying here, and do they have the resources to push price significantly higher? You ask, has the selling been absorbed, or is there more to come? You ask, what is the story this price action is telling me about the intentions of the large players? This is not mystical. It is behavioral. It is psychology applied to price. Let me give you the framework that changed my trading. When price approaches a significant support zone, I no longer ask if it will hold. I watch the behavior of price as it enters the zone. I watch for what Wyckoff called effort versus result. If price is falling with decreasing volume, decreasing momentum, smaller bar ranges, that is exhaustion. The sellers are losing their conviction. The effort to drive price lower is no longer producing the result. That is the fingerprint of absorption. Conversely, if price crashes through a support zone with expanding volume, wide range bars, and immediate follow-through, that is not a false breakdown, that is distribution. The large players are getting out, and they are using the support level as a launching pad for your optimism on the long side as they sell into it. The level didn't betray you. You misread the character of the move. This is the transformation. You stop being an observer of price levels and become a student of price behavior. You stop drawing the map and start learning to read the terrain. And then, only then, does something remarkable happen. You begin to feel less fear when you enter a trade, because you're no longer betting on a line. You're betting on a confluence of behavioral evidence. You're not saying price must bounce here. You're saying, based on what I observe, the character of the decline, the volume profile, the spread of the bars, the reaction from prior tests, the weight of evidence favors a bounce, my risk is defined, my reward is probable, my execution is calm. That is discipline. Not the discipline of forcing yourself to follow rules you hate, the discipline that comes from understanding so deeply that the rules feel inevitable. Losses become data. They no longer carry shame. A setup fails? Good. That is information. The market has told you something. You add it to the record, adjust your model, and move on with the same emotional temperature you had before. That is the standard. Not perfection, consistency, not certainty, process. And the process, practiced daily, with honesty and without ego, is what builds the edge. Not the next indicator, not the higher time frame confirmation. The process. The market is the same river it has always been. The water changes, the current doesn't. Jesse Livermore once wrote something that has never left me. He said that the game of speculation is the most uniformly fascinating game in the world. But it is not a game for the stupid, the mentally lazy, or the person of inferior emotional balance, nor is it for the get-rich-quick adventurer. They will die poor. He was right in his time. He is right now. He will be right long after every screen in every trading room has been replaced by something we cannot yet imagine. Because what drives markets, what has always driven markets, is not data. It is not algorithms. It is not geopolitical events or central bank policy, though these are the clothes the market wears on any given day. What drives markets is human nature, and human nature has not changed in 10,000 years. Fear, greed, hope, despair, impatience, pride. These are the engines. They were the engines when operators traded stocks on the floor of the exchange in the early 1900s. They are the engines today, running at the speed of light through fiber optic cables, dressed in the language of machine learning. The tape reader of the 1920s and the institutional trader of today are watching the same thing. They are watching the transaction, not the prediction of the transaction, but the transaction itself. The footprint of money in motion. Richard Wyckoff built an entire philosophy on this idea. He believed that if you studied the relationship between price and volume carefully enough, if you read the effort and the result with sufficient depth, you could infer the intentions of the large operators. Not perfectly, not with certainty, but with enough probability to trade profitably over a large sample. And at the core of his work was a truth about support and resistance that has been largely lost in the modern age of retail trading. He understood that a price level is not just a technical feature. It is a record of a transaction. It is the place where a large participant decided to buy or to sell. And as long as that participant is still in the market, still holding that position, they will defend that level. They have a reason. They have a stake. This is why old support becomes new resistance after a breakdown. This is why old resistance becomes new support after a breakout. It is not magic. It is logic. The buyers who were trapped at the old support level, who held through the breakdown in the hope of getting out at break-even, will sell when price returns. Their hope transforms into relief, and relief sells. The old support level becomes a ceiling of supply, not because of geometry, but because of the human psychology of traders who are still waiting to escape. The concept is called role reversal, but in most trading courses it is taught as a mechanical rule. In reality, it is a psychological reality. It is the story of people who made a decision, got punished for it, and are waiting for one more chance to undo the pain. When you walk into a trade at a support level, you are not just entering a price zone. You are entering a room full of memories. Some of those memories belong to people who will help you. Some of those memories belong to people who will hurt you. Your job is to read the room. The old Wall Street operators called this tape reading. They would watch the ticker tape price and volume streaming through in real time, and they would read it like a language. Not a language of certainty, but a language of probability. They could feel when a stock was being accumulated. They could feel the difference between natural selling and manufactured panic. They could tell when a breakdown was real and when it was a shakeout. That instinct, that feel for the market comes from experience. But experience alone is not enough. It has to be coupled with the right framework. The framework that says, I am not here to predict. I am here to read and to react. I am here to follow the evidence, manage my risk, and let probability work in my favor over time. This is the philosophy of professional speculation, not prophecy, probability, and survival. Above everything else, survival. The great speculators of history, the ones whose names have lasted, were not the most brilliant analysts. They were not the most sophisticated theorists. They were the ones who survived long enough to let their edge compound. Paul Tudor Jones did not make his reputation by being right more than he was wrong. He made it by losing small and winning large over a lifetime of trades. He made it by never allowing a single trade, no matter how certain he felt, to threaten his ability to come back tomorrow. That is the final lesson. That is the wisdom beneath the wisdom. The market will be here tomorrow, and the day after, and the year after. And if you have preserved your capital, preserved your emotional stability, preserved your willingness to engage with humility, you will still be here too. Most traders think the goal is to win this trade. The professionals know the goal is to still be in the game 10 years from now. Support and resistance, at its deepest level, is not a technical concept. It is a window into the ongoing, never-ending psychological drama of human beings under financial pressure. When you learn to read that drama, to feel the emotion embedded in a price zone rather than just measure its coordinates, you stop being a technician and start being a trader. A real trader, the kind who survives. I want to leave you with this. Every line you draw on a chart is a hypothesis, not a fact. Every support level is a question, not an answer. The market does not owe you a bounce. It does not owe you clarity. It does not owe you anything. What it will give you, if you are patient and honest and willing to suffer the education it demands, is this: understanding, not certainty. Understanding. The deep, hard-won, earned understanding of how human psychology moves money, how fear and greed repeat in recognizable patterns, how the strong accumulate from the weak and distribute to the hopeful. That understanding is the edge. Not a system, not a software, not a drawing tool. Your ability to read, your ability to wait, your ability to act without ego and exit without shame, your ability to lose well, which is the only way to ever win consistently. If this reached something in you today, if something I said clicked in a way that other explanations never quite have, then do this one thing: follow this channel. Not because I'm going to give you easy answers, I have none to give, but because the conversation we're building here about psychology, about market philosophy, about the deep structure of trading, is the conversation that changes careers. The market will always be there. The question is whether you will be. Master yourself first. The market will follow.